Capital One Financial buying Discover Financial Services in an all-stock deal. It's one of the largest in the world of Wall Street in a very long time. Joining us right now is David George, Baird Senior Research Analyst. Good morning to you. This is a deal that people have talked about as a possibility, sort of a fever dream for a long time. It is now here. I'm curious, upon looking at just the headline and the deal itself, you think this is going to work? It's not going to work? What's your thought?
Good morning, and thanks for having me, Andrew. From our perspective, we're pretty positively disposed towards this deal and like it quite a lot. Consumer finance and credit cards specifically, Andrew, is what we would call a commodity business. So scale is increasingly important, and consumer finance through the cycle is actually a great risk-adjusted return business. So in addition to significant cost savings, there is an opportunity for Capital One to benefit from utilizing Discover's back-end network. So that if you assume $60 billion in purchase volume, which is how much consumers use on Capital One cards, and they're able to bring that on to the Discover platform, there is we estimate between $1 billion and $1.5 billion of incremental cost savings that Capital One will be able to benefit. So from our standpoint, this is a large deal. But the integration risk compared to, and we've been doing this a long time, compared to bank deals is a lot less because in a transactional product like credit card, you don't have to worry about retaining bankers. The relationship piece is not nearly as meaningful. So despite this as being a $35 billion deal, a very large one, the largest in many years, the integration risk here we think is a lot less relative to some of the larger bank deals we've seen in our career.
The price, we're looking, obviously, Discover's now up about $14. You're looking at Capital One down a bit. It's all stock, so there's an arbitrage situation going on here.
Mm-hmm. Yeah, the price is a full one. Cap One is probably the only buyer that could pay this price. But from our perspective, it is full but fair. If you think about kind of the longer term potential at this price, Andrew, the earnings accretion going out to 2027, which is really a fully phased in kind of combined company with cost savings and synergies, is roughly 14 to 15% accretive to earnings. So that's pretty meaningful economic accretion for Capital One shareholders. Clearly, this is a large deal. There's some regulatory issues, I'm sure, that you're going to want to talk about. But from our standpoint, over the intermediate to longer term, this is a pretty good deal.
Okay, so let's hit the regulatory issues. You just mentioned them, and you could pick your person. If you are the Treasury Department, what do you think this morning? If you are Lena Khan, what do you think this morning? If you're the Department of Justice, what do you think this morning? If you're the Federal Reserve, what do you think this morning?
Well, I'm just an analyst, Andrew. I am none of those people. But so from our perspective, we don't cover Discover, but they have been dealing with some regulatory issues. So this solves a potential regulatory headache. So we think that's positive. Cap One is based in the D.C. area. So clearly we're of the view that they had to have had at least some preliminary discussions with bank regulators as well as Justice Department officials on this deal. But clearly that's going to be an open question, and none of us really know. But there has been a lot of consolidation in card in order to offer consumers the best products at the lowest prices. In a transactional business like this, we would advocate approval of a deal like this, and we think that it makes sense.
So, David, let's flip it around. Let's say your Visa or your MasterCard or your Amex this morning, and maybe we can get those stocks on the board. We should probably put up JPM and Citi as well, given the underwriting role that they play in this world. Do they look at this and say, oh, my goodness, we have a new competitor, and this is going to be a problem? Do they say, oh, my goodness, this is fantastic. Now we can say to actually everybody in Washington who's been coming after us that we're some kind of monopoly, duopoly, oh, no, look over there. We now have new competition.
Yeah, I think from my perspective, there's a couple different angles within that. And I don't cover Visa, MasterCard. My colleague David Koning does. But they are largely a Visa issuer. So if you assume this volume comes off of that network, and we would expect the international volume to stay on the legacy players, but the domestic volume to come off those rails and come on the Discover rails. And that's where that billion to $1.5 billion of synergy comes from. In terms of the industry, this is, again, particularly Chase has been very aggressive in terms of marketing spend and investing in, again, a very transactional and what we think is a commodity business. So in order to drive growth, you need a competitive advantage in order to take share, and cost and marketing skill and heft is really one of those advantages. So it's just going to continue to drive increasing competition, Andrew, in what already is an extremely competitive space today.